lot of traders use moving averages wrong, especially beginners. You've probably heard of people pushing strategies that are as simple as when the lines cross, buy, or when the lines cross, sell. The problem is, if trading were really that easy, everybody would be rich by now. The truth is, just like every other indicator, moving averages aren't designed to predict the future. They're designed to help you understand what's already happening in the market. So in this video, I'm gonna explain how moving averages actually work and help you understand what most beginners miss out on. So let's get right to it. So let's start with the basics. A moving average, put simply, is the average price over a selected number of candles. As new candles form, the calculation updates. And that creates a smooth line that follows price action. Its job isn't to tell you which way price will go next. Its job is to remove some of the noise so that you can see the bigger picture more clearly. It's like driving through a foggy road. The candles act like the fog, and the moving average act like the headlights. It helps to reveal the direction. When price is consistently above the moving average, buyers generally have control. When price is consistently below it, sellers have control, usually. That's the first thing that moving average does for you. It helps you to identify trend direction. One of the simplest uses for moving average is trend filtering. So let's look at the chart. Price is above the moving average. The market is making higher highs and higher lows. So instead of looking for sells, you focus primarily on buys. Now imagine the opposite. Price is below the moving average. The market is creating lower highs and lower lows. Instead of hunting for buys, you focus mainly on sells. This sounds very simple, something a 5-year-old can understand, but it solves one of the most common beginner mistakes, which is trading against the trend. Sometimes avoiding bad trades can be just as important as finding good ones. Now let's talk about a strategy that almost everybody knows about, the crossover. For the crossover strategy to work properly, you'll need to have two EMAs present on your chart. So this is how you set them up on TradingView. At the top of your screen, you'll see indicators. Click it. And on the search bar, search for moving average exponential. Click it, and it will appear on your screen. Now you'll need two of these moving averages. Double click on the line, and the settings will pop up. For length, set one of them to 8, and 21 for the other one. The numbers can vary depending on whatever people prefer. But for the sake of this video, I'm gonna use 8 and 21. You can change the colors. Actually, yeah, it would be better if the two lines are different colors. Otherwise, it would be really difficult to read the trend. It's up to you what color you want these lines to be. And that's how you have it. A crossover happens when a faster moving average crosses above or below a slower moving average. For example, so an 8 EMA crossing above a 21 EMA may suggest that bullish momentum is increasing. An 8 EMA crossing below a 21 EMA may suggest bearish momentum is increasing. But here's what most beginners don't realize. Crossovers are often late. The market may have already moved significantly before the crossover appears. That's why instantly buying or selling when a crossover happens can be really bad for your account. A crossover should be used as a confirmation, not the reason for the trade. So this is where moving averages become much more powerful. Instead of just relying on a single signal, you should combine them with more confirmations. So here's a simple framework for you. Step 1. Identify trend direction. Use your moving averages to determine whether buyers or sellers have control. Step 2. Find a key area. Look for support, resistance, supply, demand, or major market structure level. Step 3. Wait for price confirmation. This could be a bullish engulfing candle, a bearish one, a rejection wick, break of structure, or other signals that fit your strategy. When all three factors align, you have a much stronger setup. So let's go through an example together. This market's been falling for several hours now. Price eventually reaches a strong support zone. So as the sellers are pushing lower, you'll notice here that momentum is beginning to slow down. The candles become smaller. The market stops making aggressive moves lower. So then the buyers step in and a strong bullish candle forms. At the same time, the faster EMA crosses above the slower EMA. Now we have multiple reasons to consider a long position. Support is holding, number 1. Momentum is shifting, number 2. And the crossover confirms growing bullish strength. A trader could enter after confirmation, place a stop loss below support, and target the next major resistance level. Now before you start adding moving averages to all of your charts, you need to know about these common mistakes. Avoid these mistakes. Mistake number 1, taking every crossover signal. Not all crossovers are worth trading. Mistake number 2, ignoring market structure. The moving average should support what price is already showing you. Mistake number 3, Using too many indicators. Many traders cover their charts with indicators and end up creating confusion. A clean chart with price action and a few moving averages is often enough. Mistake number 4. Thinking moving averages predict reversals. I have a surprise for you. They don't. They simply reflect current market conditions. Moving averages are very popular for a reason. They're simple, they're versatile, and it helps you stay aligned with the market's overall direction. Use moving averages to identify trends. Use support and resistance to locate opportunities. Use price action for confirmation. When those pieces come together, you'll be making decisions based on evidence instead of emotion. Thank you for watching, and if you found this useful, leave a like and subscribe for more content like this. I'll see you in the next one.